In this video, we're going to talk about liquid market. Liquid markets have many available buyers and sellers where prices change in comparatively small increments. Liquid markets make it quick and efficient for buyers and sellers to trade in and out of securities with tight spreads and low transaction costs. Liquid markets include the money market, the market of treasuries, and many stocks and bonds. Markets for trading specialized physical goods, such as luxury items or houses, are not liquid. The market for the stock of a Fortune 500 company would be considered a liquid market, but the market for a family-owned restaurant would not. The largest and most liquid market in the world is the Forex market, where foreign currencies are traded. It is estimated that the daily trading volume in the currency market is over $5.1 trillion, which is dominated by the US dollar. The opposite of a liquid market is called a thin market or an illiquid market. Thin markets may have considerably large spreads between the highest available buyer and the lowest available seller. A thin market, by its nature, damages liquidity. Individual investors may find it difficult or impossible to get a fair price in a thin market. The most predictable thin market on Wall Street occurs every year in the last half of August, when most traders abandon their desks and go to the beach. One significant factor related to liquidity is volatility. Low liquidity, a thinly traded market, can generate high volatility when supply or demand changes rapidly. Conversely, sustained high volatility could drive some investors away from a particular market. Overall, the main advantage of a liquid market is that investments can be easily transferred into cash at a good rate and in a timely fashion.